Welcome back once again to step 5 of the instructional videos for the Investment Property Analyzer tool. In this final video on the cash flow summary, we're going to explain the summary results. So once you've gone through the calculating the gross income, the total expenses, inputting your debt service numbers, and looking at the down payment, the spreadsheet will calculate the results. Basically, the results start right here under cash on cash return and total summary. Okay, so your cash on cash return in this situation says 4.2%. To be more specific, here on the right, it says 4.18, and here it's just rounded up to 4.2. So the way that's calculated is by taking the total cash flow for the year, so taking this monthly cash flow number and multiplying it by 12, or taking this number, which is your, again, annual cash flow, and dividing it by your total down payment. Okay, and that gives you a cash on cash return. To show you that really quickly, you take 14,816 and divide by 354,750, you'll arrive at 4.18% or 4.2%. Multiplied by 100, 4.2%. Okay? Just to make sure that the calculators work or the formula is working, we can do that sometimes to double check. Anyhow, cash on cash return, 4.2%. Annual cash flow divided by purchase price. Now the average profit per unit per month is just calculating it by the unit. So it's taking this number, the monthly cash flow, and dividing it by the number of units. So you know that each unit is producing about $102.89 worth of cash flow each and every month. This is, I guess, one of the most popular calculations, and that's your monthly cash flow. Owning and operating this company, you can expect to produce just over $1,200 each and every month in cold hard cash flow. Okay, now gross rent multiplier. This is calculated by taking the estimated purchase price and dividing it by the gross rental income. Okay, really, this doesn't tell you if the property is good or bad. What it is really is just an indicator. So if the gross rent multiplier is under 10, meaning if you take the purchase price and you divide it by the gross annual rent that the property is producing, and the number is less than 10, it's a good indicator. Anything 10 or less in our market is a good sign that the property is producing good income. Okay, if it's over 10, then the property might be either a little bit expensive, or we might not be producing enough rental income. If we got all these units there that are not producing anywhere close to market rent, if we bumped all those up to 825, we would be producing a lot more rental income, and that gross rent multiplier would come down and make more sense. Okay, so again, it doesn't mean the property is bad, it doesn't mean the property is good, it's just an indicator to tell you where everything's at. Okay, and I'll skip this for a second and jump to coverage ratio. I know coverage ratio was also here, and I skipped it on purpose so we could talk about that here. So coverage ratio essentially is this number as a ratio over this number. So your net operating income as a ratio over the debt service. Another way to say that is the net operating income is 32% higher than the debt service. Okay, this coverage ratio is a number that lending institutions use to analyze how profitable an investment property is. They lend to you sometimes based on that coverage ratio. If the coverage ratio was 1.2, it would mean that there's less annual cash flow. If the coverage ratio is 1.5, it means there's more annual cash flow, which makes the property more profitable. To show you that in real life, let's just really quickly change this interest rate to 2%, which would make the debt service cheaper and make that number lower. So we change that to 2, right? The debt service just got cheaper, went from 46,258 to 39,000, almost $7,000, and you can see the coverage ratio changed. Okay, so the higher the coverage ratio, the more profitable the property on paper. Okay, so same idea here. Having this quick little summary is a really, really, really effective way to analyze a property in under 60 seconds. Again, this doesn't tell you the whole story. There's more pieces to add to this. You know, this property on average seems just okay, but given the fact that the rents seem very, very low on a lot of units in comparison to market value, there may be value there in trying to negotiate the price down as much as possible and using our own sweat equity to bring the rents up as far as we can and profit from a value added to the property that way. Okay, so I don't want this to be a be all end all. There is more research and decisions that to go into deciding if a property is valuable, even past looking at these. But this gets you at least halfway down the road, if not more. This is a great start. It's up to you to do the research on your marketplace and really decide if the property is right for you. So off to the right here, we have a total return summary, and it just summarizes your returns. So cash on cash, again, that's your basic cash return. Principal recapture is my favorite type of return calculation. And what this calculates is the return on the money that tenants pay down on the mortgage. So each and every month we're paying a mortgage payment, right, in the amount of $3,854.80. Now, part of that's interest and part of that's principal, and the tenants are paying that down for you. So that's like a forced savings account. You know, in 25 years, that's going to get paid down to zero. And how much of that are you going to pay? Nothing. Your tenants are going to pay it for you. So each and every month that they pay the principal down, we get to calculate a little bit of return. So the way we do that, if I click on the return in the formula, there's a very simple way to average out the return over a span of 1 year. And if you're on a 25-year amortization, okay, roughly about 4% of the principal is going to get paid down every year. If over 25 years, if you pay down 4% each year, that adds up to 100%. Now, this return calculation is not perfect because of the amortization tables in mortgages. You're actually, in the beginning of your mortgage, you're actually not paying exactly 4%. You're paying a little bit less, and the further you get into the mortgage, the more and more you're getting paid down. But for simplicity's sake, we're assuming we're buying this property for a long term, and on average, over a span of 25 years, you can expect at least 8.7% return, okay, or about 4% of the mortgage paid down each year. I hope that makes sense. I know it sounds a little bit confusing, but watch this video again and you'll start to understand. So look at the formula bar. What we've done is we take 4% times the total mortgage, okay, and we've divided that by the amount of down payment to give us a return number. Okay, and the last part of this is natural property appreciation. On multifamily properties, we're pretty conservative and we average only about 2%. So adding all these up gives you a solid 19% return on your money, and with a very conservative 2% appreciation rate. Okay, and down here where it says upside, I leave room for myself to take some notes on okay, rents are low on this unit, rents are high on this unit, lots of room to improve this unit or that unit. It's just a place where, when I'm looking at the property, to take notes and make sure I copy them into my spreadsheet here. Okay, these notes down here refer to CMHC loans in that $150. There's a CMHC fee when you're applying for that of about $150 per door. Okay, nothing super important, just a little note I keep there for myself. I think that's it for the property return summary section below. We will be doing more videos. And again, if you have any questions on this section or any other section in this video series, you can always send me an email direct, and I will do my best to respond to you right away. And don't be shy, because if you have a question, someone else has the same question too. So the more questions we get, the more we can improve this and continue to make this better for everyone who uses a spreadsheet. So thanks very much. We'll talk to you again soon.